Okay, very good morning. Welcome to the briefing then for Thursday the 21st of July. Just before I get on to the full briefing, we have experienced a couple of internet connection issues, so I'm going to kind of not touch my charts in terms of time frames too much, just so it doesn't disrupt the screen that I'm sharing with you guys at the moment. And also what we're going to do is a quick look at where we trade at the moment, but I want to have a more thorough look at the ECB and what to expect today. That's kind of the main event for the session, and then what action or words we might hear from Mario Draghi in the press conference will be key. But looking at the charts this morning, stock futures already on the front foot, following the close on Wall Street, generally in a positive session overnight in Asia. A couple of earnings reports have come out. Likes of Unilever, their second quarter sales growth beat estimates. Roche profit rises 7% on cancer drugs. Sab Miller's first quarter sales gains as De Bruyne awaits its takeover approach from Anheuser-Busch. Couple of other more damp areas though. Swatch first half profit declines to its lowest in 7 years. There was a couple of tech names. I think Intel were pretty poor last night. Profit fell with slow growth in key data center unit. However, eBay raised their forecasts a year after their PayPal split. So earnings season really picking up a bit of pace at the moment. Just something to keep half an eye on. If you don't already do so, please do follow our main @Amplify Trading Twitter account. I do tweet all of these in the morning as soon as I get in. Yeah, it's a good way just to kind of have your own news feed, so to speak. You can just see the headlines that I'm tweeting out with the full stories if you want to take a bit more of a thorough read. So equities then higher this morning. Consequently, Bund futures on the back foot. We've already punched through the S12 and the 166 handle before finding a bit of resistance or support, at around the 65.80 type level. It might just be my chart actually frozen. I think that's at S2 where it's found a bit of support actually in the Bund this morning. When I'm looking at this price action then, it kind of says, well, two things to me. We continue to trade up at around these record levels in the US, 2 ticks shy then of around that 2170 mark. And then also maybe a bit of pre-positioning ahead of the ECB. We're going to look at that in more detail, but ultimately I don't think personally we're going to see any actual action. However, we will see some key communication from the central bank to prep the market up for their next meeting in September. Looking at the pound, top left, you can see elevated once again fairly sharply as well, up over 100 pips already and close to retesting the highs that were seen overnight yesterday. Well, I should say late yesterday, and then in the overnight session. That R1 containing for the moment. One thing of note, look at these two peas in a pod now. The ladies are taking over. If Clinton gets in as well, what a changing of the guard, so to speak. 3 of the major countries on the planet, all run by women, and these two got on like a house on fire, if the press are to be believed. From their, they've only actually met properly yesterday, and yet the tone was very positive in terms of the way that they were talking. I've read a lot of things this morning about just the mimicking of body language, so on and so forth, which, if anything, then means that although we've heard from Theresa May that Article 50, that key, let's say, trigger for the 2-year negotiating period for the details of Britain's exit from the EU, that's not going to be actually the button pressed until 2017, but things like this are certainly confidence builders, I guess, for the market. The fact that these two have got on so well on first meet. Don't forget, Theresa May is doing, let's say, the political rounds. She'll be in France meeting Francois Hollande later today as well. So, again, these are the key people she'll need to have on side if she's to strike a good deal, whether or what shape or form that takes is yet to be seen, but as far as May has intonated, a Brexit is a Brexit. So the better relationship she can strike with these people, the more favourable terms that exit will have. Sticking with the UK as well, another thing why I think is more important for pound strength this morning is some comments out of a Bank of England MPC member. That's Christine Forbes. Now, this left-hand side is the main comment really that I think is moving the market. Keep calm and carry on is a good motto to live by, as well as good strategy for monetary policy. That to me then is a hawkish comment, and this is coming on the back of Martin Will. Although he's an outgoing member, he still does have a vote in August. Before then he leaves a few days after. So now you've got Martin Will and Christine Forbes all erring, I'd say, more on the hawkish side, which at this point I don't think affects the ability for the Bank of England to act in August. I still think that will be the case, but it's kind of how dovish are they? Now there's a I'd say a sliding scale of dovishness the Bank of England could take in August. The more, let's say, less dovish or more hawkish approach, if you like, is just a simple cut in rates. The escalating scale of dovishness comes whether they cut rates and provide further liquidity to the system, whether through funding for lending, some of their other programs, more direct to bank liquidity, or do they even go further, the most dovish scenario, and do that as well as a cut of rates and then resume quantitative easing. But if these sorts of comments of a more hawkish nature start to come out, I think that although these guys might not vote for a cut, they'll be outnumbered as a board of 9 members on the Monetary Policy Committee, but we might just get a cut and then that's it, rather than the full Monty, so to speak. I personally think that's probably a better route to go down, because they won't want to run out of ammunition further down the line if the Brexit impact starts to become more prominent. Okay, so let's take a look at the ECB. That is the main event of today. So what is the market expecting? Now, important thing here is that the market is not expecting a rate cut in terms of the majority. Now, in terms of futures market pricing, there's a 13% chance of a deposit rate cut today. So 13%, pretty minimal, but not impossible. But if that did occur, then you would get very immediate aggressive selling in the euro, given that the market is not priced for that. It's very small pricing at this point. September then is seen as the more likely month that most economists think that the ECB will act if they need to. Now, a couple of other charts here on why the ECB most think that they will take action at some point or another. So tepid lending, the pickup in credit growth since last year, still below debt crisis pace. So peak of the European debt crisis, you can see denoted by that small circle there. So we are still below that level, and that is a key metric in which the ECB, through their targeted long-term refinancing operations, they're really pushing to get that back up lending levels as a feed through into the overall economy in the Eurozone. The other key metric, obviously, for all central banks is inflation, and we are nowhere close to 2%, which is, of course, the target at the central bank. So looking at the white line, that's Euro area headline inflation, and we're tracking at 0.1. We need to be up at 2%. How do you stoke inflation? Well, some would argue quantitative easing will take care of that. So what do? You broaden and make the program more powerful in order to try and stoke inflation back towards target. So another reason why action is probably forthcoming. Now, this is kind of the key area that you'll probably hear and see talked about the most at the moment. This is the eligibility or the scarcity of bonds now available for the ECB to buy. Now, as you all know, the deposit rate that the ECB is currently negative 0.4%. But now, approximately a third of all global yields are in negative territory. Looking at Germany specifically, only 35% of the nation's bond yields more than the ECB's negative deposit rate of 0.4%. So if you look at this yellow part of the chart, the predominant section, the ECB cannot buy that debt because the yield is below the cutoff threshold of minus 0.4%. And this is the real key thing that we're looking for the ECB to communicate, is how do they intend to tackle this. Switching over to the FT, it kind of makes a bit more sense of what I'm talking about. So this is a good graphic showing the constraints in the bond market at the moment. So the dots on the left signify the share of government bonds that are too expensive, i.e. the bond has risen too much and pushed the yield too far negative. And this is the total size of the debt market in each respective government or country. So at the moment, Germany is the one that's feeling the pain the most, because over half of their market they cannot buy now. Don't forget, this is one of the most important economies within the area. It's scaling down, all the way Finland, Austria, Netherlands, France. A huge amount of these bonds are now becoming not eligible for purchase. So the FT have done a great summary here of the 5 ways to change the rules. So for me, I don't think that the 12.45 interest rate announcement, I do not think anything will happen there. There is a very small probability of a deposit rate cut. If that occurred, that is against the majority of market expectations. You would see aggressive immediate downside in the euro currency because of that. I don't think they'll do that. So then the press conference will be key, and the communication is what I think will be ultimately the tradable event here. Because if they are going to take action as soon as September, they need to set the tone, they need to lay down the path without being too committed, but giving a strong hint towards the action that they will take. Now, 5 ways then that they could act, and the key here is about the people have kind of started to question the actual impact, the validity of cutting the deposit rate any further. So that's why the QE program and tweaks to that program are key. First of all, buy bonds that yield less than minus 0.4%. That makes total logical sense from the charts that I've just shown you, and is widely seen as the least controversial option. The only problem is, if you keep lowering the threshold, and let's say the reason bonds have been rallying is because of partly global uncertainty, because of Brexit, because of China, because of problems about Italian banks, if that continues to fuel a flight to quality, that means yields are going to go further and further into negative, and the ECB are just going to be exposed to potentially bigger losses. That's the caveat of doing that. But it does make the most sense from a controversial point of view. Next rule, scrap the rule that prevents the ECB holding more than a third of any one country's debt. Third, scrap the rule that prevents the ECB from holding more than a third of any specific bond issue. And fourth, scrap the rule that keeps purchases in line with the size of member states' economies. Now, all of these come with an inherent problem, with they all start to fit along the lines of the ECB being a creditor for individual member states. That then legally starts to ask questions about whether or not that breaks Article 123 of the Lisbon Treaty, which specifically states about they cannot go in and just fund individual member states. So there's a legal argument to this as well. Looking at the fourth rule, if you scrap the rule that keeps purchases in line with the size of member states' economies, leading more bond purchases from more indebted member states, then who's going to be annoyed about that? Of course, the Germans will not like that at all. And don't forget, any broad changes towards new programs need to be ratified by the European Court of Justice, and they also need to go through each parliament of every Eurozone nation needs to give approval. I was reading a research note about the legality of changing the QE program, a note from Deutsche Bank yesterday, and it was 18 pages long. This is an absolute minefield, because unlike countries like the US, where actually it's not in constitutional law that they can go ahead and make changes. Similar in Japan, they have a rule where basically you're not allowed to do monetary financing, however you can in exceptional circumstances. The problem is that doesn't really exist in Europe. Okay, the fifth rule then, buy debt with maturities shorter than 2 or longer than 30 years. However, if you think about it, if you start buying debt at the very short end of the curve, or the very long end of the curve, generally that's the most illiquid part. Short-dated T-bills are generally used for operational purposes that are rolled on, say, 1, 3, 6 months, 12 months T-bills. They don't really get used to facilitate the actual mechanics fed through down into the system to us as consumers, so it would have a minimal effect. And then if you start going 30, 50-year bonds, that's a pretty much dead part of the market where there's zero liquidity, so you're only going to be able to buy a very small proportion of bonds. So that seems like a non-starter. So these are key areas that you need to be looking for when Draghi speaks later today. And what we're looking for is for him to hint towards which one they're siding with or which one they've discussed the most. We'll go into this in a bit more detail, obviously ahead of the event, but hopefully that gives you a bit more insight. In terms of the market reaction, if they do start to, let's say they go down the route of really opening up the program, dropping, let's say, the yield floor. You saw this before. If they start moving away from the capital key, there were some source comments a few weeks ago from the ECB, which then meant that basically less demand for bunds because investors could pick up peripheral debt. So actually, bunds would probably come under some pressure if that did occur. Just wrapping up on the news perspective, keeping you informed ahead of the Bank of Japan. We do have their interest rate decision, not this week, next week. Source comments overnight. Japanese government is preparing a package of economic stimulus measures totaling $190 billion or more. Though actual government spending is likely to be less than half that amount, according to sources overnight. Remember, these are sources. The package will have a headline figure of at least 20 trillion yen, according to 3 sources, which marks the upper end of the current market expectations. So again, these will be numbers to keep in mind as we get closer in toward that decision. Okay, quick look ahead on the calendar. So from the UK, we're looking out for a retail sales report in the month of June. Again, as we've said, with all UK economic data, given this is a June survey, likelihood is that majority of the data will be pre-Brexit. And so I wouldn't read too much into it. The ECB, of course, 2-pronged event, 12:45 for the actual rate announcement. And then you'll get the press conference with Draghi at 1:30. Same time, though, you also get the weekly jobless claims out of the US, alongside the Philly Fed business outlook. This afternoon also includes existing home sales from the US. So quite a lot to get through today. Make sure you get an early lunch. Even though I'm not expecting a rate cut from the ECB at 12:45, I would certainly be at my desk for sure if I was trading it for the what-if scenario if they cut. That is not expected by the broader market, so would cause a dramatic move across assets. The press conference, as I said, will be key, and that'll be at 1:30. Okay guys, that's your morning wrap. So enjoy your day and good luck this afternoon. Thank you.